At the end of September, when the first Chinese stimulus packages were announced, I made a video saying that I would be buying Kering. And Kering is the parent company of fashion houses such as Brioni, as Alexander McQueen, Balenciaga, Bottega Veneta, Yves Saint Laurent, but most importantly, Gucci. Now they do some other things, but Gucci is the main story here. Gucci makes up about 40 to 50% of the revenues for Kering, but has seen a very tough time. And this is mostly highlighted in the latest quarter, where the revenues were down 25 or 26% on a year-over-year basis. There are a few reasons why this has been happening, and in this video I will highlight two main reasons for it. And I will also highlight why I will be going into 2025 with Kering at an almost 14% weighting within my portfolio. So after going through some of the latest earnings and a bit of the outlook, we are taking a look at some of the valuation metrics, because it is quite important to know that, is this a cheap company? Is this a somewhat more expensive company? What is going on in the valuation part of this business? And after we have talked about that, I will explain why this is one of my main holdings going into 2025, but why I also have no plans on stopping buying this business, despite how big of a weighting it already is. But I will also explain or go over slightly why I might hedge this position, or why I am hedging this position, somewhat with a stake in LVMH. But before we get there, if you enjoyed this video, if you enjoy the amount of detail I'm going in, and you enjoy watching it and listening my thoughts about this business, then make sure to hit that subscribe button, make sure to hit that thumbs up button and leave a comment down below. But for now, I want to thank you for watching, taking your time to view this video and to get more knowledgeable about Kering. And with that being said, let's just dive straight in. And to start off, I want to take you through the latest earnings call, or at least the latest earnings report, just to see what is going on within the business, what it consists of, how we can break it down, and just to know how the overall business is trending from a numbers perspective. So let's start by looking at the overall group, right? And what should immediately stick out to you is that the comparable sales were down 16%. Now the scope was up 2% and we had a neutral or a currency adjustment of -1%. All in all, revenues were down 15% on a reported basis. And what else should stick out is that we see a worsening backdrop weighing on consumer sentiment. We see that they announced weak traffic, and we see the currency slight negative impact, but a positive impact on scope from Crete. Now, what is Crete? I will explain later. When we then look slightly further, what we can see is that the Western Europe makes up 32% of revenue. North America makes up 23% of revenue, Japan about 8%, and we see Asia Pacific at 29%. Now, rest of the world is 8%, but Asia Pacific is the big story here. This is what is being a drag on this business. And if we then look at the main part of this company, which is Gucci, then we can see that Gucci right now had $1.6 billion in revenue in the latest quarter, down from about 2.2 billion. So at the 2.2 billion last year, it made up about 50% of revenues. But since Gucci deteriorated quicker than all other parts of the business, this is now less. This is now around 40 to 45%. Now we see a drop of 25% in retail sales, of 38% in wholesales, but an increase of 9% in royalties. Now, if we then look at what they say below, they see an oversized impact from market conditions, especially in Asia Pacific area. We see newness representing about 35% of Q3 sales on average, ramping up as planned, but not offsetting the pressure from the carryover. We see a strong performance from the Jackie bag, ongoing progress in offer rejuvenation, further major handbag launches at the end of Q3 and early Q4, so that's quite important here. And we see a wholesale down on ever more selective approach and impact from current environment. So they are being more selective with what they do around Gucci in terms of wholesale. Now then we have Yves Saint Laurent, or Saint Laurent, and this has revenues of 670 million. So immediately $1 billion down in one quarter from Gucci. But last year this was 768 million and they were down 12% in terms of retail, 20% in terms of wholesale, and 17% up on royalties. Now, what they also say is that retail consisted of 76% of Q3 sales. At Gucci, you also had a note of this, and it said around 93% was retail, I believe. Now, then we have Bottega Veneta, and Bottega Veneta shows that not all is bad with luxury or with fashion, because Bottega Veneta is actually up on the year. They went from 381 million in revenue to 397. They were up 9% on retail, down 10% on wholesale, but as retail consists of 86% of their sales, they did quite alright. It's not fantastic, but they did quite alright. Now, then we have the other houses, and in this I'm gonna just take Alexander McQueen, Balenciaga, and Brioni. And what they say is that the revenues were down quite significant. 15% reported, 14% comparable. So they are not doing all too great, and we can see that in the revenues from 805 down to 686. We see retail down 10%, so not all too bad. Once again, absolutely not perfect, but not all too bad. Wholesale down 28 and royalties up 6. Now what they highlight is the success of the new handbag lines at Balenciaga, but weak traffic affecting retail performance. The first new creative collection gradually ramping up at Alexander McQueen since July, which is well received. And they say wholesale amplifying trends at both houses and Brioni posting steady growth. So Brioni is doing good and jewelry is more resilient. Now then we have Kering Eyewear and Corporate. So whenever you see someone walking around with Gucci sunglasses, they are actually from Gucci. Same goes for Yves Saint Laurent. They are from, or at least from Kering. This is slightly different to what a lot of other companies do, because they license their sunglass rights to Essilor and they let them make the sunglasses, market them, and they just receive royalties. What Kering does is slightly more difficult, but I guess also more profitable. And what we can see is that the eyewear was up slightly, about 4%. And when we see including Kering Beauté, we see this is up slightly more. However, this is very new still. And that part is up slightly more, or contributing even more. So what they are saying about the performance in eyewear is that they are seeing growth across key brands, continued investments behind brands and collections. And what they say about Kering Beauté is strong contribution from Creed, led by key markets such as North America and the UK and travel retail, development in the Middle East, and a successful launch of 2 amber fragrances. Now, the debut of Bottega Veneta high-end fragrance collection in early October is also contributing a lot, of course. Now, when we look at the conclusion, we can see what they are saying about their expectations for this year. So this is also including the last quarter. But they expect for fiscal 2024 to have EBIT, or operational profit, around 2.5 billion. So that is a slight hint about what's to come, but we will look at the analyst expectations for this year and the coming years. Because what we are looking at here is the analyst expectations. Now, what we can see in terms of revenue is that analysts are expecting about $18.1 billion, which would be down 12% on a year-over-year basis. Now, the expectations are quite well divided, because we have high estimates of 20 billion and low estimates of 17.5 billion. But I guess since we have 24 analysts with an average of 18.1 billion, I would say the average is quite low, right? The average expectation isn't that high. Now, when we go and look at the gross profit, the adjusted gross profit, we can see 13.4 billion, or a gross dollar or gross margin of 74.26%, which is around the historical average, I would say. Not even that bad. If we compare it to a few years ago, we can see 60 or 76, 74, 74, 72.5, and 74 in 2019, right before the pandemic. So the margins are historically in line, the gross margin, with what is expected. Now, what we then have is the EBITDA, which is expected to come in at 4.5 billion, and a high estimate of 4.8 billion and a low estimate of 4 billion. So they are quite evenly distributed, with about 20 analysts on this, but an adjusted EBITDA margin of 25%, which is slightly lower than it was in previous years. It is also down 34% is the expectation, but in prior years we saw 33, 35, 36, 34 and 38 in the year before COVID. Now then we come to that EBIT number, the operational profit number, and what Kering just said in their latest earnings call is that they expect 2.5 billion. Now this is slightly higher by Analyst because they say 2.668 billion, which is already quite a bit higher, but the low estimate is 2.468. So where Kering says around 2.5 billion, Analysts have high hopes. They expect it to be upwards of 2.5 billion. The high estimate is even at 3.4. Now, if Kering would come in at 3.4, I think I'd have quite a nice day in this portfolio. But I'm not expecting it from them. What we see is that this is covered by 23 analysts, so we have quite a good average. I think this is important to realize. But we can see that the operational profit should be down 46% year over year. Operational margin of 14.75%, which is historically just very low. If we go to pre-COVID, this was at 30%. So obviously this is really low. We can also see an adjusted net income of $1.4 billion expected. And this is a massive slide off of last year, right? At 3.3 billion. I mean, this is really, really, really big downturn. We can see it right here. It would be down 56%, and it would represent a net dollar or a net income margin of 7.7%. This is about half of what it was last year. And we see therefore adjusted EPS expected at 11.52. I'm gonna guess this is, it's in dollars, $11.52. And last year this was 26.9. So we do see big downturns in these metrics. Now what analysts are expecting, however, is for this number to come back quite significantly. Because what we can see right here is that they are expecting it to come up or come back next year at 16%. Then it'd be up 27% or 24%, and then the year thereafter we see 47%, but this is only two analysts covering it, so this is very skewed data still, and we will have to wait around for a better number. Now in terms of GAAP EPS, we are expecting $11.97 and it to be down 53, so it's not as bad as it is expected in terms of the adjusted EPS, but still it's not good. And a large portion of this is the debt, right? We can see right here in 2022 it was about 2.6 billion. Then in 2023 it became 9.2, and right now we are at 13.1 billion. So debt has been increasing very rapidly, and this is due to the fact that Kering wanted to take action in terms of real estate opportunities. They bought in some prime locations, but of course these are very expensive locations, and they don't want to be a real estate holding company. This is what they said, so they are looking at ways of refinancing all of it, but for now they have a massive debt load, which in all honesty also not my favorite part, but we'll have to deal with it. Now if we then slightly go down even more, we can see cash from operations at $3.8 billion expected, and free cash flow at 2.6. $2.6 in free cash flow. That is higher than what it was last year, so that is positive. However, it wouldn't be a bad thing if this were higher, right? I'd like to see it go up more. Now then, why are these numbers down as much as I just showed you? Well, that is quite simple. Remember that I said that Gucci was the main part of Kering? It's about 40% to 45% of their revenues as of now. And what we can see is that Gucci is just very exposed to Asia Pacific, which is mainly China. Now, other important regions are North America and Western Europe, but Asia Pacific and China is just their biggest market. And if we look how these markets compared on a year-over-year basis, we can see that Western Europe was down 19% for Gucci, North America was down 20, Japan was down 5, and the rest of the world was down 9. But Asia Pacific was down a massive 38%. So if that is your biggest market, and that is down that much due to the economy there, then just try and compensate that in different parts of your business or different part of the world. It's just not gonna happen. That is such a massive drop in revenues. 38% in 1 year. There's just no way to work around that. And what we can see, for example, at Saint Laurent, which also didn't do perfect, but didn't do as bad, is that they have Asia Pacific at a 27% of their revenue, but Western Europe is 38% of their revenue, and North America is 21%. And if we look at how these markets performed for Saint Laurent, we can see Western Europe was down only 5%. That's their biggest market, and it's down only 5%. Now, that's not good, of course not. But it's not as bad as having China down 38% or Asia Pacific down 38% at China, which is their biggest market. We see Asia Pacific also down 27%. So we can still see why Saint Laurent is hurting in this environment. But Japan, for example, was up 7%. But at a 6% weighting, that's just not going to do all that much. Now, Bottega Veneta did do good. And that's very easily explained, because here we see Western Europe as their biggest market, 34%. Asia Pacific, 28%, and this was down only 13%. But Western Europe was up 24%. North America was up 22%. We see the rest of the world, although it's only 9%, this was up 58%. So this is why Bottega Veneta is doing as good as it does. But their revenues were only 397 million compared to the 1.6 billion from Gucci. You're never gonna offset that. Now, these are all massive red flags, of course. And that is why I'm putting a slight hedge on with buying into LVMH. Because as we can see right here, LVMH had $60.8 of revenues in the first 9 months of 2024. So this is 3 quarters in total, $60.8 billion. I mean, LVMH is an absolute giant, an absolute powerhouse. But they have revenues from Asia, excluding Japan, at 29% of their sales. This is, of course, still quite a bit. But they have Europe at 17, Europe excluding France. France at 8, Japan at 9. United States at 25, and other markets, which is slightly behind my frame, is at 12. But this company is also very much more diversified. It's not all just fashion. And if we look at how the revenues are progressing at LVMH as a group, I'm just gonna put myself away really quickly, but we see that over the first 3 months, that at a group level, the sales compared to last year were up 3% in Q1, up 1% in Q2, and down 3% in Q3, all around being neutral. We see that in the United States, it was up 2, flat, so up 1% in total. We see Japan up 32, up 57, up 20. So Japan is doing really, really good for LVMH. We see Asia, excluding Japan, at -6, -14, -16. But -16 is very far off that -38 at Gucci. And then we see Europe at +2, +4, +2. So overall, LVMH is a way safer bet than Kering. But that's also kind of what I like about Kering. But also because I think they will do much better in the coming year, 2 years, 3 years time. Now, as I said, LVMH way more diversified than Kering is. And that is best shown here because we can see wines and spirits, we can see fashion leather goods, we can see perfumes and cosmetics, we can see watches and jewelry, and we can see selective retailing. They do way more than Kering does. Once again, this makes it a way safer bet. But also, this isn't really a company that is in the middle of a turnaround. Because if we look right here at the press releases from Kering, we can see that on this year alone, we can see that Lauren Claykin is appointed to Group Chief Brand Officer at Kering. We can see that Eva Abrams is appointed to President of Kering Americas. We can see that Stefano Cantino is appointed to CEO of Gucci, succeeding Jean-François Palus. And what we can also see is that Kering appoints new CEOs to Saint Laurent and Balenciaga, as well as that Louis Strother is appointed creative director of Bottega Veneta. Now, they do a bunch of changes around here. They also had the old CEO of Saint Laurent, who is now the chief brand development at Kering. So she's in contact with all the different houses in order to develop their brands and to be unique. So they are going through massive changes at Kering as a group, but also at Gucci. However, at Gucci, they should be done at the end of this year. So at the end of 2024, they should be done. In their latest earnings call, they asked about this, and the response was that they were trying to fix some lost senior communications positions. But after those were filled, then it should be pretty much done. Now, another reason why I think Kering currently is mispriced is because analysts were expecting some bazooka stimulus from China, like they did in 2008 to stimulate the economy. In that time, around September, that time frame, a bunch of articles were there about China releasing some bazooka stimulus, like I just said. Analysts were waiting for it. And they seemed to finally get it in September, although not quite, because the stimulus wasn't focused directly at the consumer. Now, this caused some issues and some errors in the minds of some analysts because they said that the growth target was at risk for China. And they say China's roughly 5% growth target for 2024 allows for some flexibility. However, faltering growth in recent months has prompted several global brokerages to lower their forecast below that target. China, which has rarely failed to reach its own target, last missed its growth goal in 2022 when the pandemic knocked growth to 3% in 2022, sharply lower than the target of around 5.5%. Now, more stimulus is needed urgently, said Xing Xiaopeng, ANZ's senior China strategist. The policy thinking appears to be shifted from supply to demand. There will be a significant stimulus on households' demand and public consumption. However, this large stimulus package which analysts were expecting, that large stimulus towards household demand and public consumption, that has stayed out. But what we have seen, and what I'm expecting to continue, is some pockets of stimulus going here, there, not directly at the consumer, but in ways to stimulate the consumer slightly in order to not do all too much, but to just help out slightly. And this is what I'm expecting going forward. And here we have another such article from a day ago. From CNBC, it said China's monetary shift signals economic worries, but bazooka-style stimulus is unlikely. Now, the Chinese government in 2008 unleashed an historically large monetary stimulus in response to the global financial crisis. And potential monetary easing leeway is much more limited than 15 years ago, said Tao Wang. Now, the People's Bank of China cut its benchmark one-year lending rate by a total of 156 basis points and the cash reserve ratio by 1.5% during the 2008 easing cycle. And this is also what analysts are waiting for to happen in China, like I just said. I'm just not expecting it. I am just looking at this and thinking they will go slow. Now, I'm not a China expert. Absolutely not. I have no basis to claim that. I'm just reading the headlines and I'm just trying to think it through logically. And I don't see a way in which China will immediately come out and stimulate the absolute crap out of the economy when the rest of the world is doing or seemingly doing quite okay. I mean, they don't want to look as if they need to stimulate the economy that much, right? I mean, that's I think a fair basic assumption of the Chinese economy and the way the Chinese govern their country. Now, as I just explained to you as to why the stock is down, as to why the revenues are down, and what I'm expecting from that China situation, it is good to look at some of the valuation metrics. And what I think we should start at is looking at the stock returns. Because if we look right here, we can see over the past 10 years, we can see that Kering as a stock has returned 50.87%. Over 10-year time span, 50% returns are not good. This is simply massive, absolutely massive underperformance. And if we look at it, we can see that they underperformed the SPY by 154%. But also that this underperformance just recently happened. It happened only in March of this year. That is where it started going negative. Because before we had massive outperformance. I mean, at the highs, they were outperforming in 2021 the S&P 500 at 369%. This is going from December 11, 2014 up to August 13, 2021. Kering had outperformed the S&P 500 by 400 or 369%. In terms of stock returns, they were at about 400% in that time span. In about, 7 years? That is very good performance. 50% over 10 years is not. But there is a slight difference here, and that is the total returns. Because the total returns are 102% over the past 10 years. Still not fantastic. Maybe it's acceptable for a very conservative portfolio, but 100% over 10 years is not acceptable for me. Now, when we look at that same high, we can see that the total stock returns were 511.9%. Now, this is due to the fact that Kering is returning quite a bit of cash to shareholders in the form of dividends. They have a quite a healthy, quite a nice dividend yield, which they did just cut. They got it for the first dividend payment at the beginning of next year, which I think is the absolute best choice they could have made. The payout ratio was way too high by now due to the disappointing results, and cutting it was the best thing they could have done. Now, most often this is a very big warning sign that a company is cutting its dividend. However, I think that Kering was very clear about the communication of it. And when they announced it, the stock actually rose somewhat. Because their payout ratio was creeping towards 90%, I think. It was absolutely insane. So cutting it was the only logical thing to do. Now, if we then look at the revenues from Kering, we can see that in the latest quarter they were $4.5 billion. Now, they do it per 2 quarters because this is their way of reporting. Every half year they give out a report. But if we go and look at it on a last 12 months, so a trailing 12-month basis, we can see this trend clearly going down, right? We can see it going down quite significantly. Now, this is not the first time this has happened. Coming out of 2019, going into 2020, the same thing happened. It also trended down. We can also see the same thing happening in 2017. So this is not something Kering is unfamiliar with, but it is not nice when you are an investor. We can see the trailing 12-month revenue growth on a quarter-over-quarter number. So as a percentage growth of the trailing 12 months quarter-over-quarterly measured. We can see that it is down almost 3%, 2.94%. And we can see that this has been negative over the past 4 quarters, I'm sorry. Once again, not negative. Now, if we look at it historically and we try to be extremely optimistic, which I think we shouldn't, but we could, it should come up next quarter. Easy as it is. But once again, I'm absolutely not expecting it. I think we will stay down quite a bit longer because it can be. Like you can see right here, the revenues were downtrending for a very long time. It can happen. But the key here, like I showed you at the beginning of this video, lies in China. But what we can look at to get a bit more cheered up is the free cash flow. Because we can see that the free cash flow is not doing as bad as the revenues, right? So that's a positive, I guess. But we can see that the free cash flow over the last 12 months, so a trailing 12-month metric, is trending upwards. And we can see the same for the free cash flow per share. Because here we can see that it is going from 15 to 16.5 to 17.92. So overall, the free cash flow on a per share basis is trending the nice and the correct way. Now this is a last 12-month metric, not a quarterly metric, but still it is looking quite decent, right? And I mean, that brings us to the margins, because the margins, although they are not looking good, I wouldn't say they are doing as terrible as the revenues might make them suggest. Because the gross profit, okay, it's down at 40 or 74.38%. Last quarter, it's giving me the same number and it was 40 or 76. But historically, I don't think they are all too bad. I mean, right here in 2020, we are at 72.6, at 72.58. And at pre-COVID, it was also around 74%. So overall, that gross margin, that number at least isn't doing terrible. Now, in terms of the EBITDA margin at 22.9%, that's not looking fantastic. Once again, I'm also not expecting this number to go up that much. When we look at the EBIT before, or the EBIT margin, the earnings before interest and tax, or the operational margin, we can see it at 17.5%, and this is very, very low. So that is not looking good whatsoever. But we have net income margins at 9.7%. And okay, these are way lower than what they have been, because after the pandemic, we have seen them around the 20%, around 20%-ish. And right now they are at 9. So they will have to recover. But the free cash flow margin at 11.7%, this number has been worse. It has been better, but it has also been very much worse. So overall, it's not all that bad. Especially, it is bad, but I think it is recovering and recoverable. And that recoverability also shines through within the business, or in the valuation. Because if we look at the forward PE, the next 12-month PE, it's at 19.5 at current expectations. And the word current is very important here in my opinion. And the average for 20, I mean, that is since it has been down or below it since 2022. It has been trading far above it most of the time. And even if we zoom out more, I mean, in the entire period from 2016 up to 2018, it was above it. Then it was hovering slightly below it. But then right before the pandemic, it went above it again. Now, if we then look at the free cash flow yield, at a last 12-month free cash flow, how it compares the free cash flow to the market cap, we can see that the free cash flow yield currently is 7.5%. Now, I've said it a lot, and I will say it again. The S&P 500 currently is trading around 2.6, probably slightly lower by now, because that metric was 2 weeks ago, and the market has been going up almost every day since then. So the free cash flow yield was 2.6% for the S&P 500, and Kering is now trading at a 7.5%. Now, if we look at it historically, I can think we can draw a line right here, which should be about the average of 4.5%. So we are trading quite low, quite cheap on a free cash flow basis, and a next 12-month PE ratio isn't as high, could be higher. So overall, there we already have two things that are looking quite okay. Now, if we then look at the expected EPS, I already highlighted it slightly. For next year, so 2025, analysts are expecting $10.97. I think it's dollars, I don't think it's euros. The year thereafter, $12.74. The year thereafter, so 3 years out, so that's 2027, they're expecting $15.91. But as we could see at the analyst expectations at the beginning of the video, for 2028, I think we are by then, there were only very few analysts on it, and they were expecting, I think there were 3 on it, $23.53. So that number is very skewed. I'm not gonna look closely at that. It looks incredibly good. And I'd really like it if they managed it and I'd still hold the stock. But it's not gonna be accurate. It simply isn't. But that does bring us to the conclusion of Kering. A stock I really like. A stock which has assets which are very high worth. I mean, there is only one Gucci, right? You really can't replicate Gucci. Yves Saint Laurent, very strong brand name. Bottega Veneta, also very strong but a bit less well known. And overall, they have some incredible assets. But the stock price isn't one of them. Now, I think they will recover. And I think the key to that recovery is China showing just tiny recovery. Whenever they start showing a slight recovery, I think the estimates for China will all of a sudden increase massively. And as you have seen, Gucci is a very big part of Kering. They represent 40 to 45% of their earnings or their revenues. And this was last year even more at 50%. And I think it could go there again quite easily because what I need, once again, is only a slight recovery in China. Stabilization. That's all. Just whenever that happens, I think analysts will very quickly start adjusting their price targets and their EPS estimates for Kering. And once that happens, then all of a sudden that next 12-month PE ratio starts going down incredibly fast. And once again, you only need about one earnings call. And I'm not gonna say it's the next one, the one thereafter, but I do think it's coming. And the reason for it is that China has started stimulating, not too much, and I'm not expecting this stock to be up 100% in the next year, absolutely not, but I am expecting a recovery. And in the meantime, they already declared a €2 dividend per share in the upcoming dividend payment. It's early next year. And once again, once China starts recovering, all of a sudden the EPS expectations will shoot upwards. Now they are expecting for 2025, they are already expecting $12.74. And we can see how this graph is going, right? You can see how incredibly quickly it has been going down. We can see for 2026, $15.91. Once again, how quickly this has been going down. But we can see an increase of 16% year over year and 25% year over year. And guess what will happen when EPS growth of 2025 or of 25% will start showing at Kering? All of a sudden, it looks cheap because it has a lot of growth. It has re-accelerated growth. It has renewed growth. And all of a sudden, Kering is a prized possession again. Now, that is my expectation. That is my base case. And if we talk about how much they should be valued at on a PE basis, I think they should be trading around a 24 PE ratio. Nothing very crazy, but I think 20 to 22. That's my 20 to 24. That's my guess. But that number will go down rapidly from where it stands right now as China recovers. Now, in the meantime, that China doesn't recover, I have a slight weighting in LVMH. I'm gonna try to bring this up towards around 5%, but I also want to keep buying Kering and another stock that I have been buying very heavily recently. I think these are three incredible opportunities. LVMH will not grow as much as Kering does in my base case. If Kering doesn't grow as much as I'm expecting it to, then LVMH, I think, will, because they are way more diversified. So yeah, that's basically why I'm gonna keep buying Kering, why I'm not gonna stop, why I'm gonna bet heavily on it, because I'm expecting a decent recovery into next year, but also into 2026. This is not a one-year story. I'm looking at it kind of like new management into PayPal. They need 1 year to adjust it. I think this will also take 1 year to truly start showing improvement. And then afterwards, it's off. Then it can go, it's free to run again, it's free to go up again. In the meantime, it will be down. It will not go up in incredible amount, but I think I will be positioned quite nicely around this time period. I think we will start bottoming out here quite soon. Now, thank you for watching. I hope to see you in my next video. If you like this video, make sure to hit that subscribe button, hit that like button, and let me know what you think. If it's a smart decision to buy Kering, if it's even smarter to hedge it slightly with LVMH, or if I should have gone with another business like Prada or with Hermes. Just let me know and give me your thoughts. Thank you for watching.